Thanks for all of your time today. Believe it or not, I actually debated what to wear up here today, and I stopped short of wearing jeans and a black t-shirt. But what I wanted to demonstrate was, ETFs are just funds in a different wrapper, but they also lean well into technological change, and also they're often seen as new kids on the block, and also they lean well into millennials. Just on my background, I've helped start up 4 ETF companies, helped start up ETF Securities about 17 years ago, then a company called Boost ETP, WisdomTree Europe, and then HANetf. And the first 3 companies were all actual ETF issuers, and HANetf is a white label platform, so we help asset managers launch ETFs in Europe without having to build an ETF company themselves. And obviously I believe that having recently entered into the market for the 4th time, and to help asset managers bring funds into ETFs. I believe there's still loads more growth to occur, even though the ETF industry in Europe is about 15 years old. So I think today I'm just going to cover ETFs, why you can't afford to miss out on the ETF revolution, some of the things to think about, perhaps impediments, and often they're just perceived impediments, perhaps mental stumbling blocks about whether or not to enter the market or when, and then cover off just a few things on key things to consider to ensure success. Just a few quotes there from some major consultants, also CEO of Legg Mason, and they all concur that ETFs are going to shape the future of the funds industry, and they're all very important. Take Joe Sullivan from Legg Mason there, who said in the last 18 months he's launched way more many ETFs than traditional mutual funds. So it's not just me saying this. I think you've probably seen this before in Detlef's presentation, so won't spend too long on it, but over the last 15 years we've seen increasing flows into ETFs, net flows, and on a relative basis we've seen decreasing net flows into mutual funds. So ETFs, albeit still relatively small when you consider the size of the funds market, they are increasing in importance. And here's just the annual change in assets under management over the past 15 years in ETFs. And over the last 15 years, we're at $800 million today, around 700 billion. In 2003, about $25 billion in ETFs in Europe. So about a 32 times increase in ETF AUM in the last 15 years, which is pretty extraordinary. So if you want to enter a market where the fundamentals are positive, where the market's growing, etc., well, that's ETFs. I think Europe, we view Europe as a high growth market. It's the 2nd largest ETF market globally. I mean, the US is around 3.5 trillion. Europe's 800 billion in US dollars. That's about a 1 to 4 ratio between Europe ETFs and US ETFs. In terms of ETFs as a percentage of UCITS funds, I think just this month or in May, UCITS funds went over 10 trillion euros. ETFs are still around 700 billion euros, so it's about 7%. Someone asked about the usage of ETFs before, who's using ETFs, and there is a lot of wealth managers using ETFs and private banks, and I'll come across an interesting comment from Fund Forum last week in a moment. But that to me is being 7% of UCITS funds assets and being only 10 to 20% of retail investment, and again the percentage varies on who you ask and what country you're talking about in Europe. That's still a massive opportunity. So even though ETFs have been around for 15 years, iShares has 45% market share, etc., there's still lots of opportunity in whether it's ESG or thematic or smart beta, etc. Those are good examples of where asset managers can differentiate themselves in the ETF space. I think the infrastructure and the framework around ETFs and the market generally is very positive for ETFs. I mean, we look at regulations, and regulations keep changing and impacting us more and more, etc. There's RDR. There's recently the restrictions on CFDs that the FCA came out with yesterday or the day before. MiFID, et cetera, et cetera. All these things are extremely positive for ETFs and driving things onto exchange, making issuers more transparent, et cetera. And I even looked through my notes about a year ago on a similar topic where I was just checking that I'd covered off all the major points. And one of the things I mentioned a year ago was liquidity. And obviously, there's been a manager in the press a lot over the last couple of weeks due to liquidity issues. So these kinds of things obviously help the case around ETFs. And then there's also technology. When we used to go and try and sell ETFs to wealth managers, say 10 years ago, they'd say, well, I can offer funds or I can offer securities, but what's an ETF? It's not a security. It's not a fund to me, et cetera, because it's traded. Just go buy it on the exchange. Use a different account, et cetera. And part of the reason was they needed to upgrade their technology to be able to offer ETFs. And until over the last 10 years, technology has become a lot cheaper. It's got a lot better, a lot easier to implement, et cetera. And also the demand for ETFs has increased. So a lot of these wealth managers or platforms or fund platforms that couldn't offer ETFs before or didn't see the need to offer ETFs before because it was too expensive to make the changes, there wasn't enough demand. Well, that's changing now. It's cheap to make the changes and there is the demand. So all these things are extremely positive for the continued growth of the ETF market in Europe. Just a chart there of UCITS funds generally. The ETFs are UCITS funds, and obviously they can be sold or are bought in Latin America and the Middle East and Asia Pacific, etc. So if you're getting into the UCITS ETF market, then obviously there's potential investors outside of Europe that can utilise the products as well, especially if you're doing something unique, whether it could be an active strategy. We're seeing more in ETFs today, etc., or ESG, etc. ETFs and mutual funds don't have to be, one doesn't have to exclude the other. They're obviously complementary. They can sit side by side. ETF investor pool, this chart here, the grey or the olive circle, we're showing it growing, which means, and that's consistent again with the chart we showed before, where relative flows into ETFs are gaining versus the relative flows into mutual funds, so the market share is increasing. So whether it's the green circle there that's increasing in size, perhaps even the yellow circle might be decreasing in size. But if not, as the ETF circle grows in size, it will start to impact a little bit on mutual fund investors. And as an asset manager, some say to me, well, why would I offer ETFs? I'm going to cannibalize myself. Well, do you want to cannibalize yourself, or do you want your competition to cannibalize yourself? This is where I wanted to mention when I was at Fund Forum in Copenhagen last week, we had a breakfast meeting with a global head of distribution for a very large asset manager in Europe. And we'd been speaking to their US counterparts, and they said, well, while you're in Copenhagen, meet this gentleman to talk about why we should be in ETFs. And obviously sat down and went through the spiel of why he should be in ETFs, and he said, well, I deal a lot with wealth managers, and I don't know anyone that buys ETFs. And on the panel we saw before, Andrew said that he deals with lots of wealth managers that buy ETFs. So this is a guy here that's selling to the same market but doesn't know anyone that buys ETFs. So surely that's another reason that you want to be in ETFs, because again, it's just a fund with a different wrapper, but you're actually missing out on investors that you could be marketing to, and instead you're letting your competition market to those investors. And I guess the other thing to think about too is if these people in these organisations, I apologise if any of you are here today, but if they aren't talking to anyone that's buying ETFs, are these the people that should be coming up with an ETF strategy? Or are they the ones that should be responsible for distribution for ETFs? Yes, they should be involved, but if they should be responsible, then you may not actually get the right strategy written or the right answer at the end. Highlighting again, ETFs are just another wrapper. I mean, asset managers don't generally offer just one type of product. They are offering structured products, mutual funds, OEX unit trusts, single managed accounts, alternative funds, etc., etc. And that's sometimes because of those structures were all that was available 20 years ago or 40 years ago. Sometimes it's due to the age of the funds or the products. It's obviously due to progression. And there's also different countries and different investors prefer to buy different products, for tax planning, etc. But if you're offering already all those different types of vehicles, why wouldn't you offer an ETF? I think ETFs really lean into well in the on-demand world, and I think a lot of this is due to Amazon and now Amazon Prime. But we all got Netflix, Ocado, Deliveroo, Amazon Prime, etc. And we all expect everything to be delivered to us instantaneously. And even to the point where we all used to use Amazon 10 years ago, but now we all have Amazon Prime accounts. You go on internet at night time because you're bored of television, and you buy another pair of shoes, and you press the £3 extra for the shoes to be delivered tomorrow. You've already got 30 pairs of shoes in your cupboard, and all you're doing is going to work the next day. You're not planning for a wedding or something. You didn't need to pay the £3 extra for the pair of shoes, but because we want that instant gratification, and maybe we're worried if in a week's time if it turns out we won't like it, everyone buys now using the Amazon Prime. And funnily enough, in that example, you're paying more for instant delivery. Yet with ETFs are often cheaper, or at least cost-effective versions of mutual funds, and you're getting it now for less. So to me, that's going to be one of the main reasons that ETFs are going to continue to increase their market share in the funds world. Just some examples here, and I'm not picking on the brands here at all. It's more just to show you the types of imagery, etc., that asset managers are using. Asset managers have been around for hundreds of years, etc. These are new websites. They look great, but also the imagery doesn't change very much. You got elderly people meeting someone, perhaps talking about a will or their retirement. You got pictures of the city. You got dark colours, blue colours, all the same stuff. And then obviously they're even talking about themselves. When it comes to investing, we're a bit different. So I'm the wealth manager, I'm different. Well, I'm looking at this screen here. No, you're not. You're exactly the same. And here you see the new world. What do we see? Okay. Maybe they're using green because everyone's about ESG and SRI today and clean energy, etc., etc. But these are all bright, fresh colours. They're different. This is what the millennials appeals to the millennials. You've got pictures of young people, etc., using mobile phones, and it's talking to us as a client as well. Make your money work. Invest your spare change. Your easiest financial decision. Not I'm different. Come give me your business because I'm different. So I think just to quickly summarise why every manager needs an ETF strategy. This goes as well as if you're not an issuer or an asset manager thinking about issuing products. Even if you're a wealth manager, you should have an ETF strategy. You should be offering ETFs. And if you're not, you should at least think about why you're not offering offering ETFs to your clients. Mutual funds losing market share to ETFs. Doesn't mean that mutual funds won't grow, of course, in size, but ETFs are growing more rapidly. Demand and use of ETFs is growing. Also, the product range is growing. It's still a small drop in the ocean at sort of 7% of funds under management in Europe, but that's going to grow, and it's a great time to start. It's not too late. I think the other thing I probably should have highlighted before, when I said that the European ETF market's about a quarter the size of the US market, the capitalisation of the US market and also funds in the US is about 2 to 1 US to Europe, yet the ETF market's about 4 to 1. So if the US is going to continue growing in the ETF market in size, which I believe it will, it's possible that Europe is going to catch up at some stage, and perhaps we'll grow at 2 times the pace over the next 10 years. And ETFs lend themselves well to the regulatory tailwinds that are supporting ETFs and technology, etc. Just going to cover off a few of the things that might be viewed as impediments to success. I think some of these are just mental generally, and if we go back to the screen of the old school, sometimes things don't change, so it's hard to, if you're asking the same people, do you like my website, do you like my website, it's like, yes, it's still blue and I don't like change, so it's fantastic. but perhaps maybe green still works. It's not controversial at all. So ETFs aren't for me. I'm too scared of ETFs. It's new technology. The new kids are buying that stuff. Must be dangerous. Weapons of mass destruction, I think someone called it about 10 years ago. Am I too late? No. 6 or 7% of funds under management, of UCITS funds at the moment. But also, how do you scale or differentiate yourself? ETFs can appear complex. It is a UCITS fund, albeit it's traded on exchange, so it's probably easier to buy, but it might be more complex to understand. And the other sort of potential impediments are time and cost to market, but there's other options on how to enter the ETF market. Just to give you an example of the types of clients that we've been talking to who want to issue ETFs, and if you're an asset manager thinking, when do I get into ETFs? Well, beware that other corporations that aren't fund providers are getting into ETFs. So they're going to start eating your cake as well, and probably Amazon, Facebook, etc. Baidu, all these large companies. They've got loads of data, and one day they're potentially going to be wealth managers as well. So they too may be into the ETF space. So perhaps it's time to get in there now before it's too late. But we talk to global ETF providers that aren't in Europe, mainly because they want to increase their offering to offer UCITS. We're talking to European asset managers, whether it's passive managers, whether it's active managers. Active is now becoming more prevalent in ETFs, and the Central Bank of Ireland is slowly changing its rules on what is or isn't allowed in an active ETF. Entrepreneurs and startups, that's more now that, there's white label platforms in the US for ETFs. In Europe, it's existed in the fund space for quite a while. Companies like Fund Rocket, etc., and all the banks offer white label platforms. But if you're an entrepreneur and you've got a great idea and you know that ETFs are going to grow, then you can capitalise on that by funding the launch of an ETF off a white label platform, and hopefully if it grows to beyond break even, then you're going to reap the rewards of the growth in the ETF space. And surprisingly or not, exchanges and index providers are looking to get into ETFs. Perhaps maybe smaller index providers, the MSCIs and the FTSEs, etc., probably aren't going to want to compete against their clients. But maybe smaller index providers, they're thinking, well, if I've got a great idea, why give that to someone else for a few basis points? I can launch my own ETF, and if it's US or European equities, maybe it's 20 or 30 basis points. If it's something thematic or niche or active, maybe it's 50 to 100 basis points. But why give away my IP to somebody else? And believe it or not, exchanges are looking to get into ETFs. The New Zealand Stock Exchange launched about 6 or 10 ETFs a number of years ago and have a few billion of assets under management. So it's wouldn't be surprised to me if other markets, whether they be in Africa or Middle East or Asia or LATAM, they want to develop their local capital markets, etc., or bring international service providers to their market to improve on the infrastructure, that they would also fund the development of ETFs in their market. And it could be the launch of localised domestic funds. They may not even actually have any fund rules, but often they look at what's been done in the US or Europe, or they could launch a UCITS fund, for example, and cross-listed at the home market. And there was one recently done by a UAE asset manager, and they launched a UCITS ETF in Ireland, and it was only listed on the UAE exchange. And the concentration and competition can seem scary or perhaps an impediment. The top fund there, this is Europe, $30 billion. Some very successful large asset managers with multiple strategies have $30 billion. And this is just one ETF that has $30 billion, so that can seem daunting. And then if you look at the concentration that Detlef also shared with us earlier, iShares at 44%. And I think you mentioned before as well that not everyone's just going to want to buy from iShares all the time. That's where maybe even the old school, new school comes in. And also when millennials start to take over, perhaps their parents retire and then pass on their wealth either pre or post-death, they're going to look at these websites and look at the green ones and the blue ones and go, I like green, it's talking to me, etc. And they're going to move their assets to a different provider that actually talks their language or dresses like them or uses colours they like. But just because there's concentration and competition may look fierce, I mean, this is not anything new. It's the mutual fund industry just looks like this as well. Generally, that being said, ETFs are set to grow faster than mutual funds. So if you're going to compete in a competitive market, and the competitive markets are everywhere in every product, may as well compete in a growing market. But if you take this table here is the most successful ETF launches in 2019 in North America, and lo and behold, the top two ones are ESG, MSCI USA leaders, with the same product basically, but two different issuers. About $2 billion have gone into those products in the first 5 months this year, and I mean they may not actually even listed in January or February, so it could even be less than 5 months. But when you look down at the other 8 of the top 10 ETF launches this year, you hear of issuers like GlobalX, Virtus, Aware, Innovator, Defiance, ARC. Some of these actually have built their own ETF issuance platform, and some of these are actually using white label platforms in the US. So it shows you can succeed either by using someone else's platform to launch their products. And the other thing to notice as well is the themes or the strategies here. Cloud computing, it's actually, I think, 500 million now. It was only launched a few months ago. Real asset, private credit, power buffer, which is a sort of an equity strategy that's got a sort of a floor and a cap. 5G, mobile phone technology, and fintech innovation, that's an active ETF. So there's lots of room for differentiation and creating unique products. You don't need to go and offer another S&P core product, of course, unless you're going to put billions of dollars into that product. I mean, ETFs can seem complex. Again, I would just say that ETFs are UCITS fund with a different wrapper. And some of these things that can be complex are standard for UCITS funds regardless. Share classes, registration, product structure, physical, synthetic, but everything that can be done in UCITS funds can be done in ETFs, at least with daily liquidity UCITS funds. I mean, you might not be able to put physical direct property or private equity into an ETF because it's not very liquid, but everything else that can be done in UCITS funds can be done in an ETF. And jurisdiction, main choices these days for ETFs is Luxembourg or Ireland. Listing venues is an important one because as a mutual fund provider or an asset manager who offers products in different structures but doesn't offer ETFs, you've never listed an ETF before, so where do I list, why, etc. And many make the mistake that enter the market. One listing makes an ETF. Yes, the regulatory requirement is that an ETF must be listed on at least one exchange, but there's multiple exchanges around Europe, being London, Italy, Germany, the Nordics, Switzerland, France, etc., etc. So, generally you list on more than one exchange, and people think that splits liquidity, but it doesn't because it's as liquid as its underlying. The assets aren't split, the assets are still in the fund. The trading should really be added up and accumulated. But it's important that you don't make the mistake of just listing on one exchange because you're probably only going to tap into about 20% of the business that you should be tapping into. Service providers can be different. I mean, it's just a UCITS fund. Why wouldn't my existing service providers offer ETFs? And sometimes there's specialist services that are required with ETFs, including files that get validated overnight and issued at 6 o'clock in the morning, so market makers can make bid and offer prices on exchange. I mean, on a monthly dealing fund or a weekly dealing fund or even an end of day dealing fund, that's unheard of. So that could sound complex. So you need to check that your service provider offers PCFs. They can support market makers, portals for market makers. And as I mentioned, then there's market making and real-time information. That can seem complex. I mean, we all deal in stocks. We all probably look at Bloomberg on our mobile phones or our brokerage account, and we see the real-time prices. But when we think about funds, we don't think about funds in real-time prices, real-time. That's what ETFs are, and it can seem complex, but it's not. I mean, some of the impediment as well. I mean, how you enter the market. At least white label platforms have been in the US for ETFs for a few years. Europe just recently. Previously, you could build from scratch or buy your way in. And if you're building from scratch or buying your way in, yes, it could seem daunting or an impediment. You could spend millions or tens of millions of dollars or pounds just getting to market. And I guess it depends on what things are most important to you. Do you plan to have 20 or 50 ETFs in the future? Do you need to launch now so that when you enter the market when ETFs are 7% of UCITS funds, so that you're there when ETFs are 15 or 20% of UCITS funds? If you're building an ETF issuer from scratch, it might just seem like you're building another UCITS platform, but again, there's nuances, and your staff may not be experienced in delivering things in a timely fashion because they're going to learn as they go along. They're going to make small mistakes, etc., and that creates time and cost. So it could take a couple of years to enter the ETF market. I mean, if you don't have an ETF strategy, it'll take you even longer. And then it could take 2 or 3 years to learn by your mistakes. So when you actually enter the market, when you actually get everything right, it could be 5 years from today, and it could be July 2024 when ETFs are 10 or 12% of UCITS funds, etc., or whatever the number might be. And if that's the case, then perhaps ETFs will be $1.5 trillion euros instead of, $1.5 trillion instead of 800 billion US dollars. Let's cover off a few things to think about on how to win, because that's extremely important, obviously. You don't want to have ETFs just for the sake of having ETFs, although perhaps that is a good strategy. I mean, the most important thing is get an ETF strategy. I mean, it's not too late. It's never too late, especially with the market growing. Even if your strategy is do nothing, that is 1,000% better than nothing. If you've done nothing, you won't even understand anything about the ETF market. Whereas if your strategy was to do nothing now, at least you've analysed the market. Why did you want to get into it or not get into it? What were the current fundamentals of the ETF market? What were your corporate strategic goals, etc.? And at least you've written that down, and then your conclusion is we're not going to do anything now, etc. But at least when you change your mind, or in a couple of years' time, there's some shifts in the market, or it continues, you can look at what you wrote and analyse it and say, well, I understand the market, and this has changed, and we need to get in now. Whereas if you're starting from nothing at that stage, well, then you're a couple of years behind where you could have been. And don't forget, even when your strategy might be to, yes, let's proceed, getting internal approval or assembling a team and getting a budget takes a lot of time as well. I think it's important to focus on what you're good at. I mean, we don't all need to have the choice of 20 different S&P 500 ETFs at 4 or 5 basis points. And if one gets launched at 3 basis points and you already own one at 4 basis points, it doesn't really matter. I think probably looking at different colours on this screen, but the bottom right circle covers off a lot of things that you would outsource, maybe not compliance monitoring, but fund accounting, depository, transfer agency. You would generally outsource that, and I discussed whether your service providers can offer the right service level for ETFs, and even if they're not, they may want to at some stage, but how long will that take? So you want to focus on the rest, and then again, part of your ETF strategy is what am I good at? Why am I getting into the market, etc.? Do I want to get in there quickly? I think the top circle, for example, is some of the services we offer. So that too could be outsourced. So what does that leave an asset manager with? The minimum you really need to provide as an asset manager if you want to get into ETFs, and you can do it therefore quickly, is the IP. IP in a passive index, IP in an ESG index, IP in an active strategy, your flagship funds, etc., that you might want to wrap around an ETF around, your brand. For large asset managers that have been in the market for a long time, obviously brand is very valuable. And one of the reasons, for example, we decided in our 4th go in the ETF market was to launch a platform is around leading research and track record. It's very hard when you bring out new products to always have the leading research and a great track record. But when you work with different asset managers and help them bring their products to market, hopefully you are working with clients and asset managers that have a leading research and track record in their specific field. And those things there are where you can differentiate. So even if, again, it's only 7% of UCITS assets, but if you think the market's competitive, that's exactly where you can differentiate, is in the IP, the branding, the research, the track record, perhaps a little bit on the distribution as well. A lot of the asset managers we speak to generally just want to enter the market with about 3 or 5 ETFs. Even those that build their own ETF platform often just enter the market with 3 or 5 ETFs. We've seen GSAM do that. JP Morgan Asset Management, again, in the US, did it, and then now recently in Europe. And then they also say as well, I want to enter into the market with a few ETFs now, but maybe I only want 5 or 10 ETFs in the future. I don't need 100 or 200 or 500 ETFs. On the right, you can see some of the example of some asset managers that have come to Europe in the sort of last 3 or 5 years, and generally they've launched 5 initially or 10 to 15 ETFs, and they're all sort of relatively quite focused. I mean, there's a few China asset managers there, GF Funds, ICBC, China Post, BMO had some equity strategy ETFs. JP Morgan is focused on active strategies. WisdomTree, dividend weighted income strategies. VanEck, sort of more thematic, etc. So these are examples of asset managers that have come to the market and launched sort of 5 to 15 ETFs that are focused on a specific niche. And this chart here is I call this the periodic table of the investment universe. If you want to be broad, you're going to offer everything, offer every asset class and offer every slice and dice of that asset class, or you're going to focus on a niche. The HANetf's goal is to obviously fill out this whole table here with different asset managers, but as a single asset manager, focus on what you're good at and focus on a niche, 5 to 15 funds probably. Otherwise, you've got to think about how am I going to get to that 100 or 200 ETFs, which has already been done by some of the largest asset managers. ETFs are different, obviously. Be able to get the distribution right. Again, I go back to my example. I spoke to the global head of distribution of a large asset manager, doesn't speak to anyone that buys ETFs. Well, obviously, getting distribution right for ETFs is going to be important, because if you ask that guy to come up with an ETF distribution strategy, he's not going to know where to start, because he doesn't know anyone that buys ETFs. He doesn't know why they're buying them, why they aren't buying them, which products they like, how to distribute the products, etc. Whether they're distributed the same way as mutual funds, whether it's done differently, and that will cost you time and money. The other important thing is just because they're listed on an exchange, ETFs are sold, not bought. I've seen so many managers launch products, and just because it was listed on the exchange, and they had service providers, say BBH or Boney Mellon, they say, well, it's listed on the exchange, and my service providers are going to help me with distribution. Well, your custodian doesn't do distribution, and if people don't know the product exists, then they're not going to go, no, it's listed on the stock exchange to buy it, and perhaps the spreads are going to be wide. So obviously distribution and the people around that are extremely important. One of the key differences with ETFs and mutual funds is that the liquidity ecosystem. So to have a winning strategy in ETFs, you need to get this right. I talked about the exchanges before, listing on multiple exchanges. Probably don't just list on one, list on multiple, unless you've got a very, very, very specific strategy that's maybe only relevant to a particular type of investor, or perhaps English investors, or whether maybe it's French investors. That's very rare. The market makers are important. Companies by the names of, say, Flow Traders, Susquehanna, Optiva, Virtus, etc. These are the organisations that are making bid-offer spreads of ETFs on the exchange. You generally won't do that in-house, so you'll work with one of these market makers to provide pricing, and you want to work with more than one market maker too, because if one of the market makers has an issue, their technology is down for the day, or something to do with volatility, etc., then if you're only working with one market maker, suddenly you might not have any prices of your ETFs on the exchange. And then the authorised participants, and these are generally the large banks that are the go-between between the exchange and market makers and the issuer, and they're normally the ones that subscribing for the ETF direct from the issuer. And if you're an asset manager that deals with banks, you've probably already got relationships, whether it's JP Morgan or Morgan Stanley or Barclays, Citigroup, etc. But the relationships you're going to have at those banks aren't going to be with the ETF people, so make sure you connect the dots and go and meet the ETF people. And generally, the more APs you have as well, the better it is for the product as well. All these people, again, they're not going to distribute your product for you, but it's all part of the distribution. If you don't get it right, then it's going to severely impact distribution of your funds. So get the right people and set up the liquidity ecosystem properly. And then the last thing, platforms. I mean, as an asset manager, you may have your products provided on various different platforms, etc. But you need to go through that process again. your ETF will be issued by a different vehicle. They're going to need to do compliance. They may decide not to offer your ETF because they already have 5 other versions of S&P or Euro stocks. If it's unique and niche, there's a better chance that they're going to make the effort to put your product on their platform. Some of the robo-advisors, if they're doing ETFs only and you don't have an ETF yet, and you've an ETF offering, then you've probably never even spoken to these people before. So there'll be new relationships that you're going to require to develop to get the distribution right for the ETF. And just some examples of some of the clients that we've worked with, just to give you a flavour of potentially winning strategies. On EMQQ was an entrepreneur in the US. He had experience in emerging markets. He actually has Burton Malkiel on his board. So some of you have done a CFA recently, probably have heard of Burton Malkiel. He created an index, did an ETF through a white label platform, got $500 million in the US, and said, well, I've got this IP, how do I capitalise that? And he came to us in Europe to replicate that strategy in Europe. Kuwait, example of an emerging market, well, soon to be emerging market with MSCI, a frontier market. A foreign broker came to us, and often foreign brokers are even backed by the governments in these countries, but they're looking to develop the market, and also they want to take advantage of the upgrade of first FTSE and then MSCI from frontier to emerging market status. So if you're an emerging market manager, if you're a passive manager, as an example, you'll need to hold 0.5% Kuwait. Previously, it was 0 in emerging markets. So how do you access that? Do you buy Kuwait equities directly? Do you buy the ETF? And a lot of people obviously believe that, like the China trade, in a small market that's developing, if capital is flowing into the country, then perhaps it's going to have positive returns versus other emerging markets. And then Gins Global was like an old school asset manager with closed-end funds, capital guaranteed funds. He's still got Mauritius funds that he distributes to institutional investors in Eastern Europe and Europe, for example. But he sees the white writing on the wall for old school mutual funds and Mauritian funds, etc., and wanted to get into ETFs. Didn't want to do it alone, but also didn't want to just offer. One of his largest products is MSCI World, but there's no value in him offering an MSCI World ETF. So he wanted to get into the ETF market with a focused core sort of niche range of products, focusing on technology, such as digital, healthcare and innovative technology type themes. So different sort of strategies from different types of clients or asset managers that want to get into ETFs for different reasons. And again, focusing on niche and unique products. So just to wrap up, how to succeed in today's ETFs. Firstly, get an ETF strategy. That's the start. Even if you do nothing, and focus on what you're good at, your brand, your IP. What do you do well? What's unique with your business? You don't need to focus on offering 50 or 100 products. It's expensive. Then you will be running against competition and low-cost funds. Focus on 5 to 15 perhaps, and then decide how you're going to get relative scale, because scale can be important. And then ensure that you've got the appropriate marketing and distribution strategy and the right people. Don't have your mutual fund salesperson who's never spoken to an ETF buyer before developing your ETF strategy. I think we're done. So I don't know if there's any questions at all from.
Yes, hi. Do you think there's an upper limit to the percentage by market cap that ETFs, index funds, can be before their advantages sort of peel away?
In terms of individual companies or in terms of the size of the market? Or?
In terms of size of the market.
I think there's, in terms of UCITS funds, for example, I mean, in even passive tracking funds, ETFs are still a small portion. And I'm not advocating that you should only own ETFs. I think ETFs work well with passive and active. I mean, people think that ETFs are passive. Well, they started off in the passive world. The first couple of products was a TSX 60 product and an S&P 500 product. And they're traditionally passive type investments. You should be holding equities for 5+ years, etc. If it's a core part of your portfolio, maybe you should just forget about it and leave it there for 20 years. But it's the passive ETFs are actually being used actively now because they're so liquid. and the costs are so cheap to trade some of these ETFs that it can be cheaper than trading, futures, for example, on some of the most liquid indices. So firstly, ETFs aren't always passive, but also the market's developing now where ETFs are starting to wrap around active strategies. In Europe at the moment, it's primarily around transparent active strategies. You have to disclose your holdings daily, perhaps with a lag or something. But in Australia, Canada, and now recently the US, they're going to start accepting applications on non-transparent active ETFs. So in terms of the ETF market, I mean, there doesn't have to be a limit because we're offering passive and active ETFs, etc. And then it's down to the clients giving them the tools through their brokerage account with a click button, buy now, and allow them to allocate their portfolio or let their wealth manager allocate their portfolio. So yes, passive might increase a little bit more in terms of the global markets because we're seeing that. But I don't think it's going to overtake at some stage where it's where it's a majority.
Okay, great, thanks.
All right.
Further questions?
Thank you.
Thank you very much, Nick.